Hey everybody, Vulcan Trader here. This is our fourth video, I believe, on money management for trading. And yeah, I know it's a lot of math, but it's simple math, and there's no way I think you're gonna be good at this unless you can handle a little bit of math. But it's just real simple probabilities and ratios, division, and stuff like that. And it's nothing, no crazy math. So gotta learn to tough it out, do a little bit of math for this, but. Okay, so today we're going to talk about betting big for winning small and why to do it. Okay, so I don't know if I explained this clearly in the previous videos while I'm doing it. So betting smaller so we figured out, okay, how you figure out your risk reward ratio, your winning probability, put that in the Kelly formula, and then we get a Kelly calculator here that gives you the optimal bet size for growing your account at the quickest rate, and then explain how. But we're only doing 1% for any of our trades in our examples. So the reason you do that, so like here you got I'm going to show it for 3 different examples. So if you had a system like coin flip with 50% odds of 50% chance of winning and then 2-to-1 odds, and it gives you the optimal bet size, which would be 25%. Or if we had a 30% chance of winning and 3-to-1 odds, the optimal bet size is actually only 6.67%. Okay. And let's say we had a 0.7% chance of winning, but it was a 1-to-1 odds. So you risk $10, you gain $10. Okay. And that one's 40%. But in all these situations, if you have any profitable system, whatever the value it gives you here, if you do less than the Kelly, you'll still make money. It just won't be at the optimal rate that you could grow your account at. And we'll get into, you can actually get kind of close to a Kelly or a half Kelly. It would actually, say even on the coin flip 1.5, I'll show this more in a later video, but 0.5 with 2-to-1 odds, where it gives you 25%. We're only doing 1%. If you did that, you'd actually be like on margin 3-to-1 or something crazy like that is how much it would have you position size. We'll show you how you can do 1% risk, use diversification to get you close to about a half Kelly, and then have small drawdowns. So you want to bet, you can bet smaller than the Kelly, but not more than the Kelly to still be profitable. Anything under whatever this value is, once you put it in your system and what your odds that you're getting will work. Okay, 1% works, show 50%. Okay, did that. If you're okay. And then so there's twofold. Okay, so anything under the Kelly works. Also, it keeps you from having big account swings. So like here's our Kelly testing spreadsheet here. The 25%, see it has big drawdowns, 1,843. And whereas this one, it's 1,000 only went down to 99. We had pretty good here, but if so you have small drawdowns, so that it helps you to mentally handle it better. And then the other thing is, let's say your system's unprofitable, you don't have a good hit rate or something like that. 1% will keep you from blowing up your account longer, so that you get more practice with some real money. Because trading real money is better than paper trading. If you can only paper trade, that's fine until you save up some, but it's better to play with some real money. It's kind of like playing poker with fake money. Everyone just goes in all the time and it's no fun. So you have to play with something in order to get a feel of real trading. But yeah, 1% will keep you in the game longer, even if you have an unprofitable system, so you get some real world practice. That's kind of the reasons why you do that. But we're going to Okay, and once you pick a number to risk, you have to keep using that number and use it all the time. And the reason is, okay, say we did 1% risk on this one, and then we're like, oh, well, our next trade, it's like, oh, it went down too much, let's just let it go to 2%. But if you did that, then you would have double the drawdown for that one, and it would, you'd lose $20, and it would put you back to break even. You'd be back down to 1,000. So if you just randomly pick 1% or 2%, you could randomly pick the time whenever you're going to lose, and that's going to screw up your whole system, and then it messes up the formula. It won't be consistent. So whenever you pick an amount, a profitable amount that's less than the Kelly formula, you have to stick with that amount and make sure you get, if it goes through, stop a little bit to 1.1% or something like that. It's not a big deal. But if you're doing double, then over time you could screw up your odds and make your system unprofitable just by not keeping yourself consistent. So pick an amount that you're comfortable with drawdowns, and we'll show you kind of what type of drawdowns you'd be looking at depending on what you picked, and stick with that amount. Okay, so we're going to do part of the other reason is you could get, so like in this heads, tails flipping scenario, you could get heads 5 times in a row, or you could get heads 10 times in a row. That is possible. 10 times in a row is less likely. So if we look here, I looked up odds of flipping heads 5 times in a row. It is 1 in 32, which is pretty high actually. So that's definitely likely to happen. So we're going to stick that in here. We're just going to hard code a -1 for this one, for this one, for this one, for this one, and for this one. The rest are still random. Right here, this one's hard coded, and then this matches whatever this value is here. So you see, if we did a 1, 2, 3, 4, yeah. So if we did that, and your first 5 flips, let's say, happen to be fails, then you would, with a 25% bet in the Kelly formula, you would have a drawdown to $316 from 1,000, which is huge. Whereas if you only bet 1%, it would only give you a $40 drawdown, which is very small compared to 1,000. Then if we did 2%. It'd give you more of a drawdown. Let's do 5%. You can kind of see, $773, which you'd be down to with a 5% bet. And so you got to think, well, mentally, could I handle that? And if you can't, then what'll happen is you'll get scared and you end up doing something, changing what you're doing instead of letting it play out, let the odds play out. So you got to have a bet that's small enough that you can handle the drawdowns of it. But that's, we're about a 25% drawdown with a 5% bet. So in 1%, like I said, is best for new traders getting practice. Even if you happen to be unprofitable in your hits, then it still lets you stay in the game and learn longer. And then if we did but you still see even with that, the Kelly system still plays out once you get all the rest of the random head flips, and it's the winning system here. And then we're gonna do it. So -1 here, -1 here. And we'll keep going, -1, -1, and one more -1, I believe that's 10. Yeah, so to count 10, so the odds of getting heads 10 times in a row is 1 in 1,024, but that still is a possibility that could happen when you're trading, so you got to be ready to handle that. And look at this here, down to $75. But the system's still profitable even after that, even if you got heads 10 times in a row. You're betting smaller incrementally each time. So you start betting $250, 25%. Because you're betting a percentage, it's always a smaller bet whenever you're losing. And then as your account gets bigger, it bets bigger. And then the Kelly system comes back even from a ridiculous drawdown all the way to whatever it was, $75 from 1,000. Where the 5% system, it went down to 598. Oh no, we went down to $14 here. Sorry, my bad. And $598 here is a 1%, which is what I'm saying to do. Give you a real small drawdown even with that to $895, which I think any human could handle. It's only a 10% drawdown, which gets us to our next point, which is the recovering from a drawdown. So let's say. So if you have an account, your account gets a 50% drawdown, how much does it take to get back to even? I'll wait for a second just so you can think about it. What percentage would you need to get back to break even? So you had $1,000, draw down to $500. What percent do you need to get back to 1,000? Most people just gut feeling, they'll say 50%. No, it's actually 100% is the answer. The more you get a drawdown, the larger percent return you need to get back. So here's a little table here of loss of capital and then gain to recover. So if you lose 5%, you only need 5.3% to return, 10%, 11.1, 15% drawdown, you need 17.6, 20% drawdown, you need 25% to get back to break even. And it starts getting worse, about pretty bad at about 25 to 30. You need a 33% return after 25 and a 30% drawdown. You need a 42.9, which is a big difference. And when we get back down here to, if you have 50% drawdown, you lose half your money. Then you need 100% to recover. And then 60% drawdown, you need 150% gain to get back to break even. So your losses work geometrically against you. And so that's why it's nice. It's good to keep a smaller bet size so that you don't ever have that drawdown in case you run into that rare situation where you get heads 5 times in a row or 10 times in a row like this. And so even if we had that rare 1 in 1,024 chance that we got heads 10 times in a row, we'd only have a 10% drawdown here, roughly. Well, it's a little bit more than 10, and that would we only need an 11% gain in order to get back to our $1,000. And I think that's about it for that. Yeah, I think that's it. That's it for this video. We'll get more into how the diversification can help you to get a larger bet with smaller drawdowns and get you close to a full Kelly type of bet for better returns. And so like, subscribe, and hit the bell, share it with your friends. I'll just keep more good stuff coming to you guys. Have a good day.